On October 19th, 1987, the Dow Jones Industrial Average fell by 508 points, or 22.6% in the span of a single day. The S&P 500 fell by 20.5%. It was, to date, the single worst day in the history of the stock market from a return perspective. And given that we have since put in measures that'll force the stock market to close for the day entirely if the market falls by even 20%, it will likely remain the worst day for quite a long time. But the point is, the stock market can be pretty darn volatile at times. We all know that. And while one-day swings of 5, 10, or even 20% are not exactly common, they are obviously not unheard of. Which raises an interesting question. Since the market is so volatile, at least over the short term, could we actually improve our returns and make more money over the long haul if we took advantage of those down days by timing the market? Well, the answer is technically yes, it is possible, but it isn't probable. And there's a few reasons for that, which is what we'll be covering today. As you can no doubt tell by the title of this video, today we're going to be discussing why timing the market usually doesn't work, especially over the long haul. And instead, it's time in the market that we should be focusing on. But before we get going, be sure to like this video if you haven't already, as it really does help out the channel a lot, and subscribe with notifications on for more money-related videos like this one every single week. And if you want to further support this channel, you can check out some of the links I've left in the description below, which includes a link to the investing platform M1 Finance. Get started investing for free today. So there's a few reasons why timing the market usually doesn't work out over the long haul for investors, even if they manage to get a little bit ahead initially. First, there's the emotional factor. The market can be pretty volatile, as we just discussed, and it's very tough to see your investments fall by 10 or 20% over the span of a few days, weeks, or months, without taking some sort of action to try and stop the bleeding, as it were. Historically, at least when it comes to things like broad-based market index funds, this has led to a lower long-term return for investors who take action and sell during those situations. But despite knowing that, it's still a mistake that many investors, inexperienced and experienced alike, make every single day. Another reason is that since the markets are so volatile over the short term, it's incredibly easy to miss a really good day that comes out of nowhere, and that can have a surprisingly large effect on your overall returns and the size of your nest egg over time. In fact, if you had just missed the top 10 days of the stock market over the last 40 years, you would have missed out on almost half of all your returns. Don't believe me? Let's take a look at the actual numbers. Vanguard's S&P 500 Index Fund has had an average annualized return of over 10% per year since 1980, assuming dividends were reinvested. For the 40 years from January 1980 through the end of 2019, a $10,000 lump sum investment would have grown to about $619,000. That's an average annualized rate of return of about 10.9% per year. Pretty good. However, almost half of that growth came from just 10 days worth of returns. On your screen now, you'll see the top 10 days of the fund from 1980 to 2019 based on Yahoo Finance's adjusted closing price data. There was a 9.1% jump on October 21st, 1987, just a few days after the crazy fall of Black Monday. There was a 5.7% jump on July 24th, 2002. Following that, there were 6 jumps between October 13th and November 24th, 2008. And a final pair of leaps in March of 2009. All 10 of those days saw the fund grow by at least 5.4%, with the two largest increases being the 11.6% and 10.8% leaps on October 13th and 28th, 2008. Hypothetically, let's say that John had invested $10,000 in Vanguard's fund in January 1980, but due to some incredibly rotten luck, he decided to sell his investments right before each of these 10 days, only to buy the investment right back immediately after. This is pretty darn unrealistic, I know, but it does help illustrate the overall point of how big of a difference these few days can make on your investment's performance, even over long periods of time. As we just saw, originally a $10,000 investment would have grown to around $619,000 over the course of these 40 years, had we just let it sit there the whole time. However, John's $10,000 investment is only going to grow to about $318,000 under the assumptions we just laid out. In other words, missing out on just 10 trading days over the course of 40 years cost John over $300,000, or almost half of the entire nest egg. 10 days out of over 10,000. That's pretty insane if you ask me. And as you can imagine, the numbers will only get worse with the more positive days we miss. For instance, if John had missed the best 20 days of the market instead of just the best 10, then his ending net worth would have been around $182,000 instead of $318,000. And if you missed enough positive days, you could actually see your return fall all the way to zero or even into the negatives. But with that being said, the same thing can be true in reverse. What if John had managed to miss the 10 worst days of the market instead of the 10 best? The 10 worst days of the stock market are up on your screen now. As you can see, there's a handful in the 1980s, a pair in the 1990s, and 4 over the span of around a month and a half in late 2008. All 10 of the days saw drops of at least 6.7%, but only one managed to lose at least 10%, and that was, of course, Black Monday in 1987. If John had missed all 10 of these days, his investment would have grown to around $1.6 million. That's an average annualized rate of return of about 13.55% per year. So quite a noticeable jump from the regular 40-year investment scenario, and a solid 5 times the nest egg of the scenario where John missed the 10 best days of the market. However, similar to the previous hypothetical, it is also pretty unrealistic. I mean, the likelihood that John would be able to accurately predict all 10 of these bad days ahead of time is just astronomical. But it does illustrate for us why so many people are tempted by the idea of trying to time the market. Because if you do succeed, even if it is through sheer dumb luck, the rewards can be pretty good. The question you have to ask yourself is that potential reward worth the risk of experiencing a little bit of bad luck and missing out on a few of those good days, or failing to get out in time for a few of those bad days, and as a result, seeing your overall return fall behind what it would have been had you just invested consistently? Statistically speaking, we know that the answer for most investors is that it isn't worth it, as most cannot successfully time the market consistently over a long period of time. On the bright side, one thing that I did notice is that in a pretty significant number of cases, the best days of the market followed the worst days pretty closely. We saw that with Black Monday being followed a couple of days later by a strong market rebound, but this pattern held true during most normal times as well. For instance, in 1980, 5 of the 10 worst days for the year were followed by one of the 10 best days within a couple of weeks. On March 17, 1980, the market fell by 3%. It was the worst day of the market that year. On March 18th, it rose by 1.8%, which was the 10th best day of the market that year. On March 24th, the market had its second worst day of the year, falling by 2.9%, but on March 27th, it rose by 2.1%, the third best day of the year. On April 7th, the market fell by an additional 1.9%, but on April 9th, it rose by 1.9%. As well as by an additional 3.5% a couple of weeks later on April 22nd. You see a similar pattern occurring in most years, with good days coming within a few weeks or even days of a large drop. So while it isn't a guarantee by any stretch of the imagination, and while the good days don't always fully make up for that initial drop of the bad day, it is nice to see that there's a fairly decent chance that a good day is not far off when a bad one arrives. However, that doesn't mean that we should simply wait for bad days to come and then pour all of our money into the markets. There's a couple of reasons for this, too. The first is that it's not uncommon to see a few bad days that are tightly grouped together before that really good day has a chance to sneak in. For instance, in 1982, 4 of the 10 worst days of the market for that year occurred between January 5th and February 8th. In 1983, 6 of the 10 worst days occurred between January 3rd and February 22nd, which is not to suggest that bad days always happen early in the year, or that good days never come in quick succession either, because of course they do, but if you're trying to time the market successfully, you need to avoid all the worst days you possibly can. And at the same time, you can't let that need for avoiding those bad days get in the way of being around for the good ones. And if those bad days are quite often grouped together like that, it's even tougher to consistently make accurate predictions about when to get in and when to get out. And as we saw, missing even a few of those good days, or failing to get out before experiencing a few of those bad days over the course of your entire investing lifetime, can seriously cut into your long-term returns, as well as cut into any lead you may have gained over someone investing consistently to that point. The second reason that waiting for bad days to come and then pouring all your money into the market to take advantage of the drop doesn't usually end up leading to a larger nest egg is that you're going to be missing out on additional shares and the dividend income that comes from them during the times when you aren't investing. And as we've covered in previous videos, this will put you a little behind the 8 ball going forward compared to the consistent investor in a way that's pretty tough to make up for. For instance, if John had $10 per trading day to spare for investing, and waited to invest it all when a market downturn occurred, say when it dropped by at least 5, 10, or 20%, here's how his investments would have done. From 1980 to 2019, there were 10,087 trading days. So John's out-of-pocket investment would be about $100,870. Assuming he held on to his cash until the market dropped 5% from its record high, he would have ended up with a nest egg of $1,284,268.91. If he had waited for the market to drop 10% from its all-time high, his nest egg would grow only to $1.2 million. And had he waited for a legitimate crash of 20%, his nest egg would be worth around $1,057,597. If he didn't wait at all, and instead just invested $10 every single trading day, he would have had a nest egg valued at $1,287,115.01. Granted, that's not a whole heck of a lot more than what he ended up with when he waited for just a 5% drop in the market, but it is still more. And what's immediately apparent is that the larger the dip he is waiting for is, the further behind he'll likely be in the end. So in summation, trying to time the market is very tempting. We can see why that is, just based on the difference in our hypothetical nest eggs if we manage to do it consistently over a long period of time. But we also need to keep in mind that it's just as easily to go in the opposite direction if we make one or two miscalculations on the wrong day. And even if we're able to ignore the emotional roller coaster ride we've been on when we're trying to time the market, since those days are so difficult, if not impossible, to predict beforehand, it usually isn't a strategy worth implementing. The statistics behind how typical investors and even experts perform relative to their benchmark indexes bear this out time and again. But that'll do it for me today. Once again, if you enjoyed this video, be sure to smash that like button if you haven't already, subscribe, and hit that bell next to my name so you'll be notified of all my future uploads. I generally upload every single Monday, and if you have a friend that would be interested in this kind of content, be sure to share it with them. Let's really get this information out there and start our own financial revolution.